welcome to episode 25 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. My name is Asif Suria, and I'm coming to you once again from the beautiful San Francisco Bay Area.
And my name is Tamanna Suria, and I currently attend the University of California, Los Angeles.
It is hard to believe that we've now been doing this podcast for almost 6 months. It feels like we just started yesterday. On today's podcast, we will discuss a potential bidding war for the building products company GMS, Shell denying rumors that it had plans to purchase its rival BP, the FTC clearing the acquisition of Kellanova by Mars, the merger of two grocery store chains, an update on the Warner Brothers Discovery spinoff, a stock buyback announcement by Vivek Ramaswamy's Roivant, a new CEO announcement at Asana, and a whole lot more.
Nothing discussed on this podcast should be regarded as investment advice, and please listen to our full disclaimer at the end of this podcast.
If you have been enjoying this podcast, do us a huge favor and take a moment to like, subscribe, or rate this podcast on whatever platform you might be listening on. Let's get started with the podcast and start with potential mergers. Last Wednesday, Brad Jacobs, who's fresh off his conquest of building products company Beacon Roofing Supply, made a bid for another construction company, GMS, or rather construction products company. This time he's bidding about $5 billion or $95.20 for each GMS share, a 27% premium to the 60-day average trading price of the company. The very next day, the Wall Street Journal reported that Home Depot was also considering an offer for GMS, potentially setting this pre-deal situation up for a bidding war.
GMS, which stands for Gypsum Management and Supply, is a building products company that supplies residential and commercial contractors through a network of over 300 locations and nearly 100 tool sales, rental, and service centers. The company operates through 64 subsidiaries that provide everything from drywall to acoustic roofing materials. In some sense, QXO is attempting to build a roll-up of roll-ups.
It's no surprise then that in this environment, the Swiss building products company Holcim decided to spin off its North America-focused business Ambrise, which started trading on both the NYSE and the Swiss exchange under the ticker symbol AMRZ last week.
While Brad Jacobs pretty easily gained regulatory approval for his acquisition of Beacon Roofing Supply, as he continues to acquire these building products and construction products companies to create the giant conglomerate in the construction industry that he hopes to grow QXO into, he might face more regulatory hurdles. I'm curious to see how this deal continues to develop and if regulators will start to raise any red flags as the roll-up continues to grow and grow and grow.
And it's early days at this point because we haven't actually seen a real bid from Home Depot other than that Wall Street Journal report. So once we see another bid for Home Depot, it'll be interesting to see where the whole thing eventually ends up and what the final price might be. The stock had spiked to over $100 a share after the first news came out that Brad Jacobs was interested in buying the company. And then over time, it has settled down to about $97 per share. So not a whole lot more above his original offer price. Speaking of another potential deal, Ambarella, a company that sounds like it could be making rain gear, is actually a semiconductor company based here in Silicon Valley and designs processors with a specific focus on AI vision and automotive components. I guess every company these days is an AI company, isn't it? Their processors power advanced driver assistance systems, dash cams, electronic mirrors, kind of like those rear view mirrors that are actually a camera instead of a rear view mirror. But those are some of the components this company makes.
Ambarella is currently exploring strategic options, including a potential sale. The company has already hired bankers and has reached out to potential buyers. Ambarella could appeal to chip rivals interested in their automotive portfolio. Despite the huge boom in semiconductor stocks and anything to do with AI, Ambarella is only up about 51% in the last 5 years and has actually lost a third of its value over the last decade.
Yeah, the company has not been GAAP profitable, actually the only profitability that should matter, for years, but does have positive free cash flow and a balance sheet with net cash. The culprit when it comes to GAAP profitability is the usual suspect, high stock-based compensation expenses.
The third potential deal that we wanted to discuss this week had the potential to become one of the largest deals ever if it ended up coming to fruition. Earlier this week, the Wall Street Journal reported that Shell was holding early-stage talks to acquire its rival BP. This possible deal stood out to us because we've talked about BP numerous times on this podcast, especially due to Elliott's continued involvement in the company pushing for change. However, shortly after these rumors came out, they were swiftly squashed by Shell, who stated that not only were they not considering an offer for the company, they weren't considering it for the future either. The wording of the statement was such that under UK regulations, Shell cannot make a bid for BP, or at least for over 30% of BP's shares outstanding, so they can't acquire BP for the next 6 months as well. So they are very much trying to quell the noise of a possible deal.
Switching gears to active deals that have already been announced, back in August of last year, the candy, pet food, and other food products company Mars entered into a deal to acquire the food products company Kellanova in a $36 billion all-cash deal.
Some viewers might recognize Mars from their famous candy brands such as Snickers, Skittles, which is a personal favorite of mine, Twix, which I know is one of your favorites, Starburst, Kind Bars, and so much more. Similarly, Kellanova is known for its breakfast cereals like Kellogg's, or small snacks like Rice Krispie Treats, Cheez-Its, Pringles, and more.
Earlier this week, actually to my surprise, the FTC granted the early termination of its review of the acquisition, thus approving the deal. But what surprised us more was that the spread of the deal was still hovering in the 5% to 7% range.
See, in the past, we've been pretty used to the US being the regulatory body to appease, or the regulatory country to appease when it comes to global M&A. But this time, it looks like the European Commission is the one to stir up trouble. On the very same day that the FTC granted the deal approval, the European Commission launched an in-depth investigation into the acquisition, and the Commission has until October 31st, 2025 to make a decision. This pushed the expected closing date of the merger from the first half of this year to the second half of this year.
One of the more interesting deals that actually closed last week was the acquisition of the biotech company Regulus by Novartis. As we discussed on a podcast 3 weeks ago, the deal was structured as a $7 per share in cash and a potential $7 per share contingent value right, or CVR.
The CVR is set to be paid out following the FDA approval of Regulus's flagship drug, farabursen, which is meant to treat a type of kidney disease. In order for the CVR to be paid out, the drug must be approved by December 31st, 2034. The reason we are bringing this up is because we saw a rare insider purchase by Preston Klassen, the president and head of R&D at the company, after the deal was announced, and he clearly seemed to be betting on the CVR getting paid because he was buying shares at a price above the pure cash offer for the deal.
Yeah, he seemed to have a lot of confidence in the deal, especially the CVR, as you mentioned. And like most biotech deals, this one closed quickly as well, and it was completed in just 56 days after the announcement. So these CVRs are non-tradable CVRs, so there's no way to get exposure to them at this point, but something to keep an eye out for in the future where you see an active deal and there's insider buying going on at the same time.
In fact, speaking of biotech deals, we had another new deal announced in mid-June with the acquisition of Sage Therapeutics by Supernus Pharmaceuticals for $561 million, or $8.50 per share in cash. Supernus is paying a premium of 26.87% from the stock's last close. Sage Therapeutics had received an unsolicited bid from Biogen in January, which the board ended up rejecting. The company indicated that it was exploring strategic options in February. The premium that Supernus is paying is even higher than reported when considering the price of Sage from before the Biogen offer, because after the Biogen offer, it had already run up to a certain extent.
Yeah, usually these biotech deals tend to have a very large premium, so I was surprised to see the premium wasn't that large. but you actually have to go and look at the time before the rumor came out or before the company said it was going to put itself up for sale to get a true idea of the premium paid. This one also happens to have a non-tradable CVR attached to it. The CVR entitles Sage shareholders to receive up to an additional $3.50 per share. The CVR is actually split into 4 different milestones related to the sales of Sage's drug to treat postpartum depression. So you basically get $1 when there's a first milestone met, another $1 when the second milestone is met, and so on and so forth.
We wanted to briefly cover another newly announced merger, which was Cantaloupe, a digital payments company for the retail market, being acquired or is set to be acquired by 365 Retail Markets, another retail technology products company that makes things like the self-checkout kiosk that you see. The deal is valued at $848 million, and under the terms of the agreement, Cantaloupe shareholders will receive $11.20 per share in cash, representing a premium of 17.89% from the stock's last close.
Continuing on with this retail theme, CNS wholesale grocers went shopping last week and picked up a fellow grocery store chain, Spartan Nash, in an all-cash deal valued at $1.77 billion. Instead of finding Spartan Nash in the discount aisle, CNS decided to pay up for the acquisition, with the $26.90 deal price coming in at a hefty 52% premium to the last closing price of Spartan Nash.
That's a very massive premium, especially for a grocery store.
Indeed.
Spartan Nash operates nearly 200 grocery stores under various banners like Family Fare, Martin's Supermarkets, and D&W Fresh Market. The company also has a wholesale business that is used to supply military commissionaries and independent grocers.
Yeah, I've never heard of any of these chains, but I have heard of CNS Wholesalers, which owns, I think, the Piggly Wiggly brand of grocery stores. But if the name CNS Grocers or CNS Wholesale Grocers sounds familiar to most of us in the special situations world, it is because the company had previously played a key role in the proposed $25 billion merger between the supermarket giants Kroger and Albertsons. And they had agreed to purchase 579 stores from Kroger and Albertsons to help address the antitrust concerns that deal was encountering.
Unfortunately, the Albertsons and Kroger deal ended up falling apart, as many of us know, and Albertsons ended up suing Kroger after the deal failure, claiming that Kroger ignored feedback from regulators and turned down better offers for store divestitures.
Getting back to the CNS and Spartan Nash deal, one of the first things we checked to determine if this deal could also get in trouble with the FTC was the geographical distribution of their stores.
Yeah, it looks like CNS mostly operates on the East Coast and southern states like Texas and Florida, as well as 2 West Coast states. On the other hand, Spartan Nash is focused entirely on the Midwest, so a little bit more of a geographical spread, not a lot of overlap.
Yep, I didn't see any overlap at all. I wonder if there was going to be some potential concerns that both of them supply wholesalers and independent grocers. So if there is likely to be any overlap, it could be on that front and not the retail locations they have. The tiny 1.4% spread on the deal indicates that the market also thinks this deal will go through without any problems. The deal is expected to close by the end of this year. There was another thing we experienced towards the end of last week. The DOJ seemed open to certain remedies that the Juniper and HPE deal were providing. The DOJ said if they were willing to make a few changes, they could potentially approve that. So overall, it feels like this year the regulators, as many of us are expected, seem to be open to letting deals go through, sometimes with certain remedies, either divestitures or certain behavioral changes, which was another strange thing that we saw come through on a deal last week.
Yeah, but oddly enough, even though the FTC appears to be a little bit more forgiving, a little bit more lenient here, it looks like the European countries are stepping up to the plate, as we saw with the whole Mars and Kellanova situation that we just discussed.
Yeah, I mean, in some sense, we have been antagonizing them with all the tariff talk. And maybe this is their way to get back at us.
Maybe. All right, moving on to spinoffs. 2 episodes ago, we dived pretty deep into the Warner Bros. Discovery proposed spinoff. of their high growth streaming and studios businesses from the legacy cable assets and global network segment. The deal was structured in such a way that the global network segment, or the parent, would retain up to a 20% stake in the streaming and studio spinoff, but also absorb a majority of the company's $38 billion debt load.
Naturally, bondholders were not happy that the parent company was getting the short end of the stick when it came to the debt load. And typically, bondholders would be able to join together and fight back against this deal, which clearly would be unfavorable for them.
However, Warner Bros. Discovery did something very different when structuring this spinoff. They included a non-boycott covenant which prohibits bondholders from agreeing with each other to not provide loans or buy new securities from its successor companies for cash. Essentially, bondholders were to be prohibited from forming cooperative groups.
As a result, the bondholders overwhelmingly approved its corporate split and new capital structure. But why would bondholders approve a deal that's arguably worse for them? It's the threat that if an existing bondholder doesn't tender the bonds and consent to the deal, then they will end up at the bottom of the capital structure of the new company. Bondholders who refuse to tender would remain unsecured creditors.
The introduction of this non-boycott covenant is something that Warner Bros. Discovery is pioneering in the world of finance. The company is one of the first to introduce such a concept, and its success in terms of this deal may threaten bondholders' power in the future for other companies as well, who decide they might introduce certain covenants, similar ones.
I find it surprising that something like this could potentially get through without bondholders really fighting back. So it's possible that we might see some lawsuits before this happens or potentially after the spinoff takes place.
I believe bondholders were working with a law firm in regards to the Warner Bros. Discovery deal prior to the covenant and the deal passing through or being approved by bondholders, but nothing came of it at the end of the day. I think they were unsuccessful.
Got it. It'll be an interesting case study, if you will, on the credit side of things, which is something we don't normally focus on. A spin-off that was announced last September is finally happening. Ralliant, which is the precision technologies division of Fortive, will be spun off from its parent on July 1st. Fortive itself was spun out of Danaher in 2016, and in some sense, Ralliant is Danaher's grandchild.
Ralliant provides advanced testing and measurement solutions across various industries, including aerospace, automotive, and healthcare. Ralliant's 2024 revenues were $2.2 billion, and it operates in over 90 countries, so this will be quite a large spin-off. In fact, once the company becomes publicly traded, it is set to replace Wolfspeed in the S&P 600 small cap index.
Yeah, the spin-off kind of reminded me of ABB's plans to spin off its robotics division, which seemed to be on ice at this point, but that was a very large spin-off as well. Switching gears now to stock buybacks, Vivek Ramaswamy, who showed up on the public radar when he joined the race for President of the United States after launching his campaign in 2023 as a candidate for the Republican primary. Before he was known as a potential presidential contender, the world of finance got to know him for founding the holding company Roivant.
Roivant was set up as a parent for a group of subsidiary companies, all that had names ending in Vant, and that worked on drug development programs that were acquired from large pharma companies that had stopped working or had deprioritized these programs. Some of these subsidiary Vants were also public companies, such as Eurovant, Myovant, and Immunovant.
Both Myovant and Eurovant had successful drug approvals, and Sumitomo Pharma acquired the shares of both subsidiaries it didn't already own for well over $2 billion in total, generating a nice windfall for Roivant. Another one of these Vants, Telavant, which focuses on inflammatory bowel disease, was acquired by Roche in 2023 for $7.1 billion. Roivant owns 75% of Telavant, and Pfizer owned the other 25% when the company was acquired by Roche.
This unusual structure with a bunch of subsidiary Vants under the main parent company is why Roivant consistently reports operating losses with large bonanza payments when one of the subsidiary Vants hits the jackpot. The company, which has a market cap of $7.74 billion, also has $4.8 billion of net cash on its balance sheet.
This net cash probably prompted Roivant last week to announce a $500 million stock buyback, representing 6.5% of the market cap at announcement. This follows a $1.5 billion buyback that they announced last year. Roivant followed through on this earlier buyback, and they actually bought back 16% of shares outstanding over the last 5 quarters, which is different from a lot of companies that announce a buyback and either don't follow through on it immediately or are simply doing it to offset stock-based compensation.
Absolutely. And while buybacks are normally positive news for companies, a buyback announcement that we came across this week turned out to be the exact opposite. Torrid Holdings, a plus-size apparel company, announced a $20 million buyback. And such a small buyback would be something we normally don't pay a lot of attention to. Except this repurchase wasn't from public shareholders on the open market, and instead, shares were being bought back from the private equity group Sycamore Partners.
Torrid was initially part of Hot Topic, a company that was taken private by Sycamore in June 2013. The company was spun out and taken public in July 2021, and since going public, Torrid's stock is down over 87%, and in the last week alone had dropped another 40%.
The massive drop in stock price over the last week was driven by the announcement that Torrid was pricing its secondary offering at $3.50 per share, which was roughly a 31% discount to the $5.10 that the company was trading at earlier. The stock dropped nearly 38% in a single day as a result, especially considering that Torrid would not receive any of the proceeds from this offering. The 10 million shares in the offering were being sold by various stockholders, which understandably made investors panic, sell, and then the stock dropped as a result.
So you have to consider that not only does Sycamore Partners want out of its investment, and mind you, they've already sold hundreds of $millions worth of Torrid stock in the past, but so do other major stakeholders. Furthermore, these insiders were simply unable to sell at the roughly $5 per share price the company was trading at in the past, and they had to sell at a pretty significant discount to dump these shares.
Adding on, we normally see stock prices drop slightly following a secondary offering or the announcement of a secondary offering, but at least in those cases, the company benefits slightly by receiving the excess capital or the cash put into the offering. In this case, though, Torrid is actually losing capital since they have to spend extra money to repurchase the $20 million of shares from Sycamore, cash that they don't exactly have or can't afford to lose. The company has a debt balance of almost $450 million against a market cap of $325.72 million.
Considering this is a mall-based retailer, I bet a large part of that debt is probably capital leases and not just traditional debt as you would think of it. Sycamore still has a majority stake in the business, but at least this furthers the process of exiting the investment. I'm curious to see if Torrid will be able to recover from such a dramatic drop. Markets generally tend to overshoot the mean and beat down a stock to death. So you'll see some mean reversion in the meantime. But Torrid isn't that good of a company to begin with. The margins are terrible and the company isn't growing.
Another unique buyback announced this week that we briefly wanted to cover was the online travel company MakeMyTrip entering into a share repurchase agreement with a majority shareholder, Trip.com, where MakeMyTrip is expecting to repurchase $3 billion of its Class B shares from Trip.com, reducing the shareholder stake in the company to below 20%.
I've followed MakeMyTrip for several years and I've used this service to travel in India. Following this transaction, Trip.com will remain the company's largest minority shareholder, and in order to fund the purchase, MakeMyTrip launched an offering of convertible senior notes.
In fact, speaking of India, this move in some sense was a geopolitical move, as MakeMyTrip is largely based out of India, and Trip.com is a Chinese company. There's been ongoing tensions between the two countries, and many Indian companies are strategically providing Chinese investors exit. The Indian fintech company Paytm, for example, reduced Alibaba's stake from 25% to under 5%, and then the Indian food delivery app Zomato took a very similar approach for their Chinese investors.
MakeMyTrip has also faced allegations from rival EaseMyTrip of data security risks, especially in regard to travel data for the Indian Army due to Chinese influence on their board of directors. This strategic move, in some sense, is a response to that allegation, especially considering the repurchase also reduces Trip.com's board representation from 5 directors to 2.
As I always like to say, transitioning over to C-suite transitions, 10 months after the productivity software company Asana announced the appointment of Sonali Parekh as their new CFO, they also announced a new CEO this week after founder Dustin Moskovitz indicated that he wanted to step down as CEO. Daniel Rogers will start his role at the helm of the company that is significantly trailing its rival Monday.com on July 21st.
Both Sonali and Daniel have their work cut out for them at Asana. Daniel Rogers was previously at companies like Rubrik. I think he was president there for about 3 years. He was also at Salesforce and Microsoft. And more importantly, he was briefly part of Frank Slootman's C-suite team at ServiceNow. Overall, I think that the new management team is positive for Asana and could help the company bridge the valuation gap with Monday.com, which trades at 15 times trailing sales compared to Asana's 4 times sales valuation.
Another struggling technology company that announced a new CEO this week is Fastly, the CDN company that has seen its stock drop by 91% over the last 5 years. The company's new CEO, Charles Kip Compton, is an internal promotion, and he previously served as Fastly's chief product officer.
In case of troubled companies, I usually prefer to see a new CEO coming in from outside the company rather than an internal promotion, but it's too soon to see how this might play out. Fastly's stock was down 59% during his tenure as a chief product officer before he took on the CEO role. Before joining Fastly, he spent the vast majority of his career at Cisco, eventually rising to the role of CTO of Cisco's enterprise networking and cloud division. Kip Compton has a bachelor's and master's degree in computer science from MIT and an MBA from Wharton. So very strong education background in addition to a long tenure at Cisco, rising up through the ranks to one of the highest levels at the company.
Moving on to yet another C-suite transition, and it was a somewhat shocking one this week. We saw Randall Starr, who was the co-CEO, co-president, and CFO of the Frontage Retail Properties REIT, FrontView REIT, kicked out of his positions. The board of directors terminated his employment effective immediately following an investigation by the audit committee and outside counsel, who found that there was reason to terminate this employment with cause, as the committee had determined that he had violated his employment agreement. However, the board did note that his termination was unrelated to the company's business operations or previously reported financial results.
They always like to say that, don't they? And usually you don't get enough information about what actually happened. But it was interesting to see that Mr. Starr started out as an investment banking analyst and then served as the COO of Topgolf for 10 years from 2005 to 2015. He joined FrontView in September 2024 as co-CEO, but had been involved in the portfolio since 2016. He was appointed to the position of CFO just 2 months ago, so to see his employment terminated so quickly is shocking.
Yeah, FrontView REIT stood out to me because the company went public a little less than a year ago, but we'd always see various insiders purchase shares, including Randall Starr himself. The company pays a modest dividend of 3.47%.
Shifting gears to another company with a new CEO appointment, the iconic restaurant brands company Yum Brands, best known for restaurants like KFC, Taco Bell, and Pizza Hut, just announced a new CEO appointment. The current CEO, David Gibbs, who has been with the company since 1989 and eventually became CEO in 2020, was planning on retiring by Q1 2026, but it seems as if the company has sped that process along slightly.
Effective October of this year, Christopher Turner, the company's CFO and chief franchise officer, will take over as CEO. Mr. Turner's appointment is a fairly exciting C-suite transition, especially considering his extensive background. He joined the company in 2019 as CFO and Chief Franchise Officer after having spent about 3 years as an SVP at Pepsi. Prior to joining Pepsi, he was at McKinsey for 13 years, reaching partner level, so evidently he has deep experience in both the industry and when it comes to management and business operations.
Wrapping things up, a sudden C-suite departure worth mentioning is at the REIT Postal Realty Trust, which is a company that we've covered at Inside Arbitrage multiple times in the past, because it's one of the few REITs that has an occupancy rate of almost 99%, because all its customers are essentially post office locations across the US. CFO Robert Klein is leaving at the end of June, and the president is stepping in as the interim CFO. I have talked to Robert Klein, and he seems to be very much on top of what was going on with REITs quite broadly, and we've discussed management changes at other REITs in the past. He decided to pursue an opportunity at a privately held real estate firm after working at Postal Realty for over 4 years. It's possible that, like many of us, he expected the company to be eventually acquired by a larger firm like Blackstone, and that kind of event has not yet occurred, and maybe he wanted to explore other opportunities.
And with that, we will wrap up episode 25 of the Special Situations Report. What we've covered today is just a brief overview of the special situations landscape, so if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com. For daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities, such as the merger arbitrage tool, check out insidearbitrage.com.
And if you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.
As for our disclaimer, this is a reminder that the podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice, and we do not warrant the completeness or accuracy of the content or data discussed in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions.